Wall Street just got a reality check, and it came from the last place anyone expected, OpenAI. The darling of the AI revolution may have just cracked the foundation under tech's biggest winners. Let's break down the damage. The S&P 500 dropped 0.5%, closing at 7,138. The Nasdaq took the real beating, falling nearly a full percent to 24,663. The Dow barely flinched, down just 0.05%, hanging tough at 49,141. But here's what's quietly screaming in the background. The 10-year Treasury Yield jumped to 4.35%. That's a meaningful spike. Money is moving, and it's moving away from risk. So what happened? A Wall Street Journal report dropped a bomb. It claimed OpenAI missed its revenue and user growth targets. Now, OpenAI denied it, but the market didn't care. Oracle sold off. CoreWeave got hammered. Anything with AI stamped on its forehead took a hit. Think about it. The entire tech rally of the last 2 years has been built on one assumption, that AI growth is unstoppable. One report questioning that narrative, and the Nasdaq loses nearly 1% in a single session. But here's the kicker. It wasn't all doom and gloom. Energy stocks rallied. Defensives held firm. The Dow barely moved because old-school industrials and value names absorbed the blow. This is a rotation, not a collapse. Smart money isn't panicking, it's repositioning. Meanwhile, away from the AI drama, Erasca, a small-cap biotech, got absolutely destroyed. Down 48% in one day after disclosing a patient death in a cancer drug trial. That stock went from a 52-week high near $24 to under 10. Biotech giveth, and biotech taketh away. Now zoom out for a second. Geopolitics is tightening the screws. A new Reuters poll shows Trump's approval sinking to a new low as the conflict with Iran drives cost of living fears higher. Oil prices are climbing. Airlines are hiking fares aggressively, and passengers keep booking anyway. That tells you something critical. Consumers are still spending, but they're feeling the squeeze. Inflation pressures are not going away. And that rising Treasury yield. It's the bond market whispering that rates might stay higher for longer. The yield curve spread sits at a normal 52 basis points. Unemployment is at 4.3%. The economy isn't breaking, but it's not loosening up either. The Fed has very little reason to cut. So what's the bottom line? Market sentiment is still at 63 out of 100. That's greed territory. People are still buying dips, but today showed us something important. The AI narrative is fragile. One credible headline can shake billions off the table. If you're riding the tech wave, stay alert. If you're diversified, today was just noise. Tomorrow brings housing starts, building permits, and durable goods data. If those numbers come in hot, expect that Treasury yield to climb even further and growth stocks to feel more pressure. If this breakdown helped you see what Wall Street doesn't want you to miss, smash that subscribe button so you never fall behind.